The stock market is open and is looking fairly green right across the board, unless you are someone who is heavily invested in the semiconductor space. Although overall they have had a strong performance, today a lot of the industry is down, and we're focusing on another company that is down. It's AbbVie, down more than 12% today. We're going to discuss why this company has started to crash. Is it now in undervalued territory, and should we consider adding to the portfolio? First thing to note, the main reason for why they have dropped, we can see their shares do come down after the schizophrenia drug trial unfortunately doesn't have the success that they were intending. Now, what exactly were they looking for this? We can in fact see the studies did not show a statistically significant improvement in patients using the medicine. So market reacted in a way that it typically does with this kind of news, but also bear in mind this company did just report fairly decent earnings in which they increased their earnings per share. A target previously 1067 to 1087 lifted to 1090 to 1094. Now, when we take a look at the performance year to date, it is still up around 13%. Over the last 12 months, up around 23%. So both year to date and last year, it has lagged slightly the S&P. But over the last 10 years, up around 174%. And we will compare the overall performance, including dividends reinvested, towards the end of the episode. Now, right now, after the drop we are seeing, it is trading in the midpoint of the 52-week range, and we can see a double buy rating, Seeking Alpha buy, Wall Street buy, and although Quant do give it a hold at 3.41, it would need to be 3.5 to turn them as well into a buy, so not far off. A fairly attractive starting yield, 3.3%, and a forward P of 18.24, which is lower than the S&P's current position around 25.5. So what about their earnings and their previous earnings? Well, what we can see over the next 4 quarters, they are expecting growth year on year to the EPS. They just beat, as we said, also lifted EPS guidance by around 8 cents. But when we look back over the last 4 quarters, 50% track record, 2 out of 4. We also note growth is expected over the next full year, ultimately lowering that forward P down to around 16.48. Now, it isn't just that guidance that they did raise that investors will like to see, but especially for those that are more focused on the dividend, they also announced an increase of around 5.8%, which will be paid out the new higher rate from February 2025. So let's take a look at the underlying metrics. Is it a high quality company, or in fact, is it one we should forget altogether? First thing first, dividend safety score 80, it is safe. We'll come on to these 2 valuation methods shortly, and as we just heard them announce a dividend increase 5.8% October 2024. Now, for those that want to know, it was reaffirmed beginning of August, and ultimately safe dividend score suggesting a dividend cut is unlikely. Now, in terms of the last recession, how did they perform? 07-09. Well, they weren't a dividend paying company back then, no comparative data, but they did have plus 10% recession sales, well above the average of the S&P that sat at negative 12. Now, in terms of dividend growth, over both the last 5 and the last 10 years, we have seen some very nice increases. In fact, that's 14% year on year over the last 10. And on top of that, they are also a dividend king, 50 plus years of consecutively increasing the dividend, whilst also paying a dividend for the last 100 without a reduction. Now, in terms of the valuation, what we can see when we zoom into over the last 12 months, Blue Bucket, as always, giving us the intrinsic value. This model essentially tells us that this company over the last year, for the vast majority, has been trading well above its intrinsic value. Only right now are we seeing it come in and at the upper end of what the fair value looks like. But remember, we will run it through our own valuation model towards the end of the episode and come to our conclusions. Now, dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. 3.76, currently lower than the 4.15, so this is an overvaluation signal. The same to be said for the forward P, 14.7, above 10.5 rolling average, but it is marginally lower than the healthcare sector as a whole at 16.8, and this is something we will look at on a side-by-side analysis against the sector median. So let's jump into the first metric, the free cash flow payout, where we focus your attention on, given the earnings is susceptible to manipulation by management through accounting, and we can spot potential dividend cuts by looking at the free cash flow. Now, below 50% for biotechs, pretty much straddling around that year on year, 48% in 23, 51% over the next 12 months. So no surprises. We should ideally expect nice high single digit growth from AbbVie moving forwards. We then move on to the free cash flow, where we want to see consistent growth over the longer term. In fact, they've more than 6 times it over the last 10 years, moving in the right direction. Actually very positive to note. A marginal increase anticipated as well over the next 12 months. In terms of sales growth, 3 to 7%. Remember, 3 to 4 at a bare minimum, just to keep up in line with inflation. We see very good growth, in fact, over the last 10 years. However, a 6% drop in 2023 and only a 1% increase on a trailing 12-month basis does give us a sign that potentially they are coming to a tougher period in terms of their top line growth. In terms of it from a numerical standpoint, no, we can see more than double, 20 billion in 2014 to 54 in 2023. We also note they would have diluted your position as a shareholder if you were someone who bought in 2014, 1.61 billion to 1.77. And remember, our main focus on this channel is to identify companies who return excess cash, not just through those dividends, but also those share buybacks, something we haven't noted today for AbbVie. We then move on to ROIC. We want 10% or more. Give us faith. Management are able to effectively allocate their capital. For biotech industry, though, we do see around 25% year on year. Something we can see with AbbVie pretty much straddling around that. Some years better, some years a little bit worse off. And we note 22% on a trailing 12 month. We then move on to operating margin, where ideally we want to see not just above the 25% that AbbVie has done year on year, but also increasing over the longer term to note some efficiencies. Unfortunately, whilst we don't see that, it is fairly inconsistent. Positive though, it is well above that minimum 25. Same to be said for the free cash flow, looking very, very good, more than 20% consistently on a year-on-year basis. We then move on to the net debt to EBITDA, which references the earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see. And remember, these numbers are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.85. Now, the reason why we draw your attention to this metric, it correlates to dividend safety, balance sheet strength. Unfortunately, it has been above that year on year and expected to increase over the next 12 months. So something we do want to bring to your attention. And when we come to our margin of safety in the valuation aspect of today's episode, do bear this in mind. Now, we also want to let you know we've released our latest free weekly article this morning, and we typically deliver one to your inbox every single Monday, where we talk about undervalued stocks that we believe deserve your attention, as well as what's gone on in the market over the last few days. So click below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information, the upside that Wall Street see themselves as well over the next year. And on top of that, you can grab a copy of 22 undervalued stocks that Wall Street themselves believe have the most upside out of the S&P 500 right now in the market. So click below, sign up, and you can read straight away. We then move on to insider ownership that sits at 0.25%. We see 130 million worth of sales over the last year, but we don't see any buying. Now, more recent quarter, no buys, no sells. Q3 though, around 62 million worth of sales by these insiders, and the more recent one, in which you could argue outdated for today, 5th of August, the chairman sold around 66,500 shares. In fact, the month prior also sold around 283,000. Now that is a lot of money, but again, outdated, and we would argue insiders sell for many reasons, personal or financial. Information, as always, is there if you want to take a decision in your thesis. Institutional ownership, well, 70%, 6.6 billion worth of sales over the last 12 months, around 3 times as much in terms of buyers during the same time frame. So institutions very bullish, not only over the last 12 months, but also in the more recent quarter and the last 4 quarters. So we can see clearly here, institutions do like AbbVie and continue to add overall on a net position to their portfolio. Now, we've already covered their top line, where we did say their revenue has grown more than double over the last 10 years, looking very good, although we did see some signals of troubled times over the last year as well as on a trailing 12-month basis. But what we want to point out today is the bottom line net income. What story does that tell us? And what we can in fact see is very inconsistent over the longer term. And whilst it has pretty much more than doubled from 1.8 in 2014 to 4.9 in 2023, there is quite a lot of inconsistency on a year-on-year basis. So definitely something to flag, definitely something to be aware of if you are considering adding this to your overall portfolio. Then we move on to the health check, cash versus total debt. As we can see, cash very inconsistent as well. 8.4 billion in 2014, 7.3 in the latest quarter, so a marginal drop over the last 10 years. But remember, that one number is never going to give you any part of the story, which is why we compare it to their total debt numerically and directionally, which unfortunately has been increasing quite rapidly, which is why we did see the net debt to EBITDA fairly high, although you could argue from the highs of 2020 it has started to come down. 15 billion reported then in 2015, 71 in that latest quarter. We then move on to the valuation, where they get a D-. The PE sits at 18.24 with the sector median at 21.33. So if you are buying this company right now, in fact, you are getting a discount of around 15%. Question is, does it deserve a discount? Is it that poor in comparison? We're going to take a look, but pretty much no matter what valuation metric you do use today, AbbVie is coming in at a little bit of a discount. Now, growth rate comes in at an F year on year, not even 1% growth with the sector at 7.4. Forward looking, again, not even 1% with the sector at 8.39. And the disappointing thing here again is that their earnings per share, while increasing or anticipated 8.4 over the next 3 to 5 years, the market does look higher at 11.1. We then move on to profitability, which seems to be their strong point at an A+. Gross margin 71%, sector median 58%. Bottom line 9.22, which is very positive when you consider the sector at -4%. And the one thing that looks very good is their cash from operations over the last year, 16.5 billion versus -14 million from the sector median. Now, a quick recap: we have a double buy from Seeking Alpha and Wall Street. Quant, we'd say, on the fence with their hold. D- on valuation, F on growth, with an A+ on profitability. Now, two more things before we jump into our valuation, comparing AbbVie's performance against others in the biotech industry. And what we noticed over the last year, including dividends reinvested, before today they were actually the best performing. Right now they sit around third place. When we expand to over the last 5 years, we do see them in the top 2 position, up 153%. Over the last 10 years, we again see them top 2, 314. So very strong. Question is, can they continue this performance? And we'll show you the outperformance of the S&P. But do remember, past performance does not define the future. So we can see, in fact, when we take a look over the last year, AbbVie has outperformed, including dividends reinvested. Over the last 5 years, again, the conclusion is the same. And over the last 10 years, by quite some distance, AbbVie has performed very strongly. Question is, can they repeat this strong outperformance, or perhaps do we need to consider low-cost ETFs? Now we're going to jump into the valuation, and in today's episode it is coming to 195, the average of these 4. And as always, if you do enjoy the episode, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's get into how we got to this very quickly. We have Graham's valuation, EPS for AbbVie, long-term growth rate, AAA corporate bond yield, giving us an intrinsic value which comes in marginally under the 175 market price, giving us our first overvaluation signal. Remember though, we're not looking at any of these in isolation. We then have the multiples valuation, companies in a similar sector and size, their average PE multiplied by the EPS of AbbVie, where we do get a nice undervaluation signal. We then move on to the third model, dividend discount, where we see nice increases year on year. On average 6.83, we've gone a lot more conservative, 4.75, where we get our second undervaluation signal by quite some distance. We then move on to the DCF model, free cash flow year on year. Average growth, 31%. We want to be very, very conservative at 2. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And as we can see, our intrinsic value, 3 undervaluations, 1 overvaluation, coming to $195. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for AbbVie or any others. And as always, we do an MOS starting off at 10%, where we execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode, a buy up to $176, pretty much what we're saying right now. If you're buying now, you're getting a 10% MOS. Wall Street themselves, as we saw earlier, giving it a buy rating. They have their forecasted price at $214, where they see 22% upside. Now, this is one that I hold in my own portfolio. However, my cost basis is significantly lower and isn't one that I would be adding at a 10% MOS. But we keep going at 15% at buy at 166, at 20% at 157, 25% 146, and at 30% around $137. Give us your thoughts below, but as we said, today's episode, 10% MOS, 22% upside. Do you believe it is a buy, hold, or sell? And as always, click on the pinned comment below, sign up to the free weekly newsletter, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and have a great day, and we'll see you all on the next one.